Please follow us and join in the conversation on Twitter @Advisor Podcast, where you can suggest ideas and themes you'd like the Trap team to discuss. Also remember to like and subscribe to our YouTube channel and leave a 6 out of 5-star review on iTunes. Doing all this really helps us, which means we can do more to help you. Now let's head over to the studio for the latest pile of Trap.
Yes, indeed, dear Trappists. Welcome back to what many people are calling episode 38 of the Real Advisor podcast, TRAP Trap. My name is Lick Mink, and I'm already having a tech nervous breakdown. Joining me in the pretty crappy studio of doom, digital studio of doom, are the three other horsemen of the apocalypse. Carl the Voice Widger, Alan the Storyteller Smith, and Anne the Ultra Heart. Now, gentlemen, we have a show packed full of absolutely nothing. So let's start unpacking it straight away with some more high-energy review reads read out by my good friend, the Right Honourable Mr. Andrew Hart.
Thank you very much, Nick. 2 reviews today. The first one is from Good124. It's entitled, Would Have Been 6 stars, however. Excellent podcast and very insightful for someone coming into the industry. I've been a financial advisor planner for 1 year now, and this podcast is gold dust. Would have left a 6 stars rather than 5. However, episode 24 made me walk around my house checking all my smoke alarms, which I then later discovered while listening in the car. The noise was on the podcast and not in my house. Next review from Jonathan Rowley. That was you,
summer.
Alan.
That was me in the summer in my little
in your
studio.
skiing lodge or whatever it was.
Whatever. Yeah,
anyway, final
summer.
review from Jonathan Rowley entitled Trap Feedback. Thanks, 5 stars. New listener and catching up on back episodes. I've been an IFA advising for 32 years and the podcast resonates with myself and my team. Keep up the good work, enjoying the banter, proper financial planning, clear values and proposition, cost of funds crucial, focus on the important stuff, the client relationship, keen to hear more. Interestingly from that, one is from an advisor who's been in the business 1 year and one is from an advisor who's been in the business 32, and they're both getting a lot of value, which is superb. So please do keep leaving the reviews. We're a bit light on 2024, but hopefully that will change very shortly. Back to you, boss.
Thanks, chum. Thanks for that. Thanks for the reviews, peeps. Do please keep them coming in. As Andy said, we need some for this year. Okay, let's just go straight on to the topical tidbits. We've got loads to get through today, and that'll put a timestamp on this episode. I'm going to quickly lead off. In the last episode, I mentioned a Trappist question, more of a statement posed by a non-advisor guy called Mark, who's a telecoms engineer from memory, and we were talking about his experiences of working for or dealing with a very old school kind of dinosaur IFA firm who will remain anonymous. But I got a reply from Mark because I asked him, is he still a client of this particular firm? And he said, no, I'm doing it on my own. I'm going 100% into the great companies of the world. He's transferring existing funds from Standard Life, and it's been a disaster. Mark tells me he's doing it in species. I could fill a couple of episodes of Trap on this. The initial transfer forms were completed and accepted in June 2023. Welcome to our world, Mark. The in-specie transfer is finally in progress now, but about 2/3 of the funds have moved over. But to say it's painful is an understatement. I agree with your philosophy of not tinkering, unlike ABC Wealth Management and their managed pension, where the logic doesn't work and creates the customer trading fees and not even the best returns. Their fund choices were ridiculous, full of bonds and money market funds. Well done, Mark, on you on leaving them, and well done on you on trying to go out on your own. And I hope the in-specie transfer happens sometime soon. We're going to come, I think, on to the woes of Aberdeen or whatever they're called in a later topical tidbit. Okay, Mr. Hart, Transact.
Yeah, this is Transact announcing that their fees are, again, continuing to come down. The big news is their buy commission, which has actually come down quite a bit in recent years, is going to be abolished from the 1st of March. And also they're removing some of their other wrapper fees. So it's just a good news story, really. The only 2 providers that I can clearly remember from being in this business have reduced their fees consistently is Vanguard and Transact. So yeah, more good news. I think fund management fees are coming down. I think platform fees are coming down. The jury's still out on advisor fees. Are they going to come down or sort of plateau? So yeah, that's just it, really. Transact, a good news story. Their fees are reducing on the 1st of March.
Okay, good stuff. That's a good news platform story, but Storyteller.
Just a couple of items which were in the news last week. First one was widely reported Aberdeen. Now, Aberdeen obviously are a large player in our marketplace. They're an asset manager, they're a platform provider, and they've even got an advisory business. They hit the news for all the wrong reasons recently, in that they've laid off 500 people, made them redundant, or getting rid of people in the next couple of months. The key reason, and they're not the only ones to have done this, the key reason is it's the asset management business. Aberdeen are 400 to 500 billion of assets under management, the vast majority of which is active management. And clear, there is obviously a global shift certainly away from underperforming active managers, when people are slowly but surely seeing the light and saying that perhaps it's not worth paying these huge fees for continued underperformance against a benchmark or an index. And so, they've had to lay off staff. I'm advised that the platform is unaffected because they are a platform provider, as I say, but they're not the only one. Baillie Gifford also announced layoffs, staff cuts, etc. recently. And our old friends, St. James's Place, were also in the news recently for, again, similar reasons. Share price fell 9% in one day. So there's a lot of change going on. There is this huge global shift in the way personal finance is marketed, is operated. There's a focus on reducing costs for the ultimate beneficiary, being the client and the investor. It's a good thing. In the short term, there is, however, going to be some pain, undoubtedly. Nick?
Yeah, this IFA Forum Google group that I kind of run, there's quite a thing last week about the absolute woes people are having with the sort of Elevate Standard Life platform scenario. Apparently, the service standards have just fallen off a cliff.
Yeah, I'm not trying to be. I think people know that we do use the Aberdeen platform. We were an early adopter. We were one of the first companies to adopt it way back in the day. A lot of these organizations will go through significant challenges and changes. They are kind of, I think, transfer. I can't remember exactly what the phrase is, but you sort of move the technology onto a newer, better platform. So they've got something about to be rolled out called Advisor OS operating system, which apparently is going to be the state of the art, all singing, all dancing. However, there's a lot of pain people are currently going through, and we can vouch for that in the last few months. There's a lot of challenges. The challenge is when you've got active clients already on the platform, they've got income payments going out and all these sort of things. And then you move it off the one platform onto the other. And I don't know any sort of massive sort of tech project that just runs smoothly. No issues, no problems whatsoever. Again, I suppose that's a benefit for Transact. They've got their own technology, they've built their own technology, and presumably they're improving it on a sort of day-by-day, month-by-month basis without having to rely on third parties. Most other platform providers use third parties like FNZ and others.
Yeah, that's why platforms like Transact and Fundament are so worth looking at. Andy?
Yeah, I'm just a bit confused what's going on with Standard Life at the moment. I know the Standard Life brand is still there. I know the Aberdeen brand is still there. I know a chunk got bought by Phoenix. It's all very confusing.
Something, we're pretty close to them. I don't think
you don't know what's going on either.
I don't know, and I'm not sure some of the people who work there know. It is a sort of just a complex Byzantine mystery of Phoenix bought the brand called Standard. I thought Standard Life was sort of effectively closed down as a brand. And then I saw on some bus stop recently a massitive advert for Get Your Standard Life pension.
Yeah, they were still operating. I did a couple of switches recently.
Very mixed messages, isn't it?
That's the Phoenix brand. That's the original. That's now Phoenix bought the brand, bought the name. So that's
so Phoenix is still promoting the brand. Yeah, I
think Phoenix use this kind of. They've got the Phoenix brand for the kind of legacy. They bought a bunch of companies, didn't they? They bought a bunch of sort of old-fashioned businesses, packaged them together. But I think in terms of proactive going out to market, they're now using the Standard Life brand. So I can tell you, it is confusing for us. It's confusing for customers and clients. It sounds like it's quite confusing for the company themselves. It's a mystery, but maybe it will be unraveled and revealed during the course of the year.
Okay, thank you. We'll get to Carl in a second. I'm sorry, Carl, you're a bit down the list today. Mr. Hart, lifestyling.
I think a couple of us have covered this, but I believe, I think her name's Claire. She reports for the FT. She runs the FT podcast.
Claire Barrett.
Yeah, she did a podcast recently and obviously an article about it. Lifestyling, pension lifestyling, when moving to your, a nominated retirement age, you move from high returning assets to low returning assets on the assumption that you may or may not be buying an annuity. We've covered this before, but there's two elements to this. There's missed returns from moving from high returning assets to low returning assets. Missed returns is one issue, opportunity cost, etc. The other issue is now outright capital destruction. So she was reporting like people in low risk portfolios, low risk investors, cautious retirees getting hit by a 32% decline in capital value. So this sort of bygone way of managing, pension funds, advisors need to be on the front foot for it. Long story short, pretty much telling your clients to turn it off if that makes sense for the overall financial plan, et cetera, et cetera. So again, it's reared its ugly head again. The FT has popularised it. Me and Alan have been banging on about it for a few years, and hopefully you've been on the front foot with your clients. I call this a six-figure tick box. If you tick the wrong box, oh yeah, I'm okay with lifestyling, or I don't want it on. It's a six-figure tick box if you have certain value in your pension. Over to you, Alan.
Six-figure tick box in that you tick the box without thinking because the phrase lifestyle sounds positive and it's cost you 6 figures of capital loss, which is unlikely to be replaced just at the time that the last thing you need, which is but a few years before retirement, works against you.
There'll be no recourse though. There'll be no recourse for it.
So here's the thing, and there was a lot of kind of back and forward. This was in the Financial Times at the weekend, an article, sad case. There was somebody who had contacted the FT, had £200,000 of his pension fund, and he went to look at it again sort of a year or so before his retirement, and he's lost a third of it because he moved it into long-dated gilts. And of course, we all know what happened last year. And of course, now, just to be clear, the purpose for these lifestyling funds is to protect the income that you're expected to take. So you're buying long-dated gilts, which move in line with annuity rates. So in theory, this person if the fund fell by a third, the income that they could have purchased with the rise in gilt yields would have still been roughly the same. So in theory, it kind of works, and these worked historically okay when everyone was buying annuities. The aim was to protect the purchasing power of your fund. Now, I was looking recently, I can't find any up-to-date information about the percentage of people who actually buy annuities at retirement. Last data was a couple of years ago, it was about 20%. I think it's probably a little bit higher than that now with rates, interest rates having, gilt yields having gone up, annuity rates having improved quite significantly in recent times, but 20-25%, which by default means that the vast majority of people approaching retirement are going to be hit negatively if they're in a lifestyle fund. The other thing that happens regardless is that your pension commencement lump sum is a factor of your fund. So that is going to go down regardless whether you're buying an annuity or not. And the whole thing here, there's a guy called Henry Tapper. I don't know if you know, he's an actuary, or he works for an actuarial firm. He's always talking about pension related issues. And this is a wide scale secret problem that not many people know about. There are hundreds of thousands, millions of people in workplace pensions across the country who are impacted by this, and they don't really know about it. They'll just have a look at their pension fund and think, wow, what happened there? Oh, the markets must be rubbish. Pensions are terrible. I've lost a third of my fund. This is dictated by
billions has been wiped off. Billions has been wiped off real people's portfolios.
Unlikely to be recovered within the time they've got to retirement. And no one's really taking it. There's no accountability for this whatsoever.
Devil's advocate on this. I agree with you. Devil's advocate on this. We live in a highly litigious environment. You've got people with 100% equity funds, no lifestyling in place, and just before they retire, the equity markets go through one of their 30 to 40% very typical declines. They'll be all over their pension company / HR functions, whatever, looking for redress. It's a really difficult thing. The mass unadvised GPP market, these people would be livid, wouldn't they? So it's hard. It's a hard thing. We're trying to square a circle with it.
Correct. But we're talking about predominantly workplace pensions here. I believe there's a significant responsibility that employers must take. Employers in turn are advised by, they've got trustees and they've got external consultants, got employee benefit consultants. There has to be an education process here. It's hard to give everyone independent advice. If everyone had people like us and other Trappists.
Read impossible, not hard, impossible.
But information, education, lots of reasons that you would stick to the plan. The other thing that came out, you saw our friend of the podcast, Dan Weston, posted something at the weekend as well about his wife had just been enrolled in her bank's pension scheme. That asset
Just an
allocation
absolute bag of spanners, financial
is
trash, pointless,
absolute-
overcomplicated. Like, I mean, it was a
beyond
joke.
ridiculous what she's got.
0.5% in some tiny fund of nothing.
0.15%. An absolute rounding error makes zero impact on. And I think she's 39, and the retirement age is 65, and she's got all this nonsense. And of course, again, who's responsible? Somebody has made that decision. Again, I'm going to say an external third-party pension consultant has advised the employer, in this case, a bank, and it's utter nonsense.
Andy,
My final point: the only asset class allowed in pensions for people under 50 should be global equities. Every other asset class should be banned from anyone's portfolio that's under 50. That's my bold statement.
Okay.
Anyway, back to you, boss.
Okay. Well, just to summarise how bad. I mean, we know that with Nest, I think it is, or certainly was the case, that young people enrolling in Nest, 18, 19, 20-year-olds, 21-year-olds, were going into gilts initially in the early years because the culture said, well, we can't show them statements where the values of their funds fall in the early years because they might then opt out. It's just like, oh my God, pandering and just uck. Right. So there are links to various things about the lifestyle
And then gilts
in the
collapsed.
show notes.
Hooray.
Yeah. Which actually, well, that's good for them actually, because they're buying a lesser. That's actually it's going to work out for them, but it shouldn't work out for them, if you know what I mean, because they're saving on a regular basis into an asset class that's collapsed through the floor. Carl, sorry, voice, just to wake you up, it's your go.
Yes, indeed. I just on that point, Nick. It's not as straightforward as lifestyle funds are terrible because of everything you pointed out. So that's why I stayed quiet on that, because there's intricacies in that for absolute sure. Anyway, we had the Metas Ireland team planning day for 2024 in January. I did a kind of LinkedIn post on it and got a good engagement. I wanted to mention it for two reasons. Number one, we did a great exercise where we paired everybody off because we've a good few new people, and we kind of had 3 pages where I had to interview Nick, say, and ask him, what are the 3 most important moments in your life? What are your values? That kind of stuff. It was bloody brilliant, and everybody really, really, really engaged with it. It was really good. And then the second thing we did, we have done an employee survey. We did it kind of towards the end of last year, and we brought in Tommy Geary to kind of present the results of it, warts and all, which was really, really good. Our net promoter score is 59, which apparently is really fantastic. So I was delighted with that, but work to do for sure. And there are things we need to do for the team. And, getting this feedback is you can't ask for the feedback and then when it comes in kind of ignore it or be pissed off at it. You got to act, so you really do. So look, anybody who's building a team or has a team kind of more than 10 people, I think these are really valuable things to do. Just wanted to mention it.
Just a couple of one point on that. We know firms in the UK that do anonymous staff surveys and have 2 staff members. Work that one out.
True story.
Okay.
Well, three staff members, to be fair.
Okay,
But yeah.
Right, good point. Right, so moving on. Thanks for that, Carl. Yes, don't need to comment on it, but it's worth noting for the record that in the US there's a record amount of retail investor money sitting in cash, around $6 trillion, and that's a record amount. So the markets in the US went on a bit of a tear last year, as we know. So that must have been institutional investors going in, driving up the prices, while retail investors sit on the sidelines and miss out on those gains. What to infer from that, I'm not too sure, but it's very hard to think that when that money leaves cash, when interest rates do start coming down again, they're going to go back into equities, which will give them a boost. But $6 trillion sat in cash, waiting to be invested in the USA.
In the UK?
No, in the USA. That's why I mentioned dollars. Mr. Hart.
Yeah, that just plays into the hands of the banks, doesn't it? They're just going to make a margin on that, and also the investment platforms, they're going to make a margin on it. But yeah, that would sort of make sense because the market's at a high, which means people are most fearful. So,
yeah. Sorry, Alan, I was short with you. What was the point you're trying to make?
Thank you, Nick. I'll forgive you. In the UK, I tweeted this last week because I saw some data that the FCA had published. Let me just quote it. 37% of all investment/savings are 100% in cash. This is retail customers, according to the FCA. 37% are 100% in cash, and an additional 18% have all their investments and savings 75% in cash. The average cash rate currently in the UK is 1.99%. I know you can get more with a sort of fixed term bond or something, and you can but most people don't bother. Again, data quoted, the average person doesn't bother. They get whatever their Bank or Building Society gives them. And there are some billions in accounts with 0% interest rate. Large scale wealth destruction going on in slow motion in front of our eyes, happening all the time.
Yeah, good point. Good point, well made. Okay, very quickly, Mr. Hart, Financial Planning Week.
Yeah, I'll just put it in the topical tidbits. Financial Planning Week is this week, January 22nd to the 28th, or just sort of finished. I believe it's run by the CISI, and various firms do various awareness projects around this. I haven't seen much about it. I've just loosely come across it, so that's it really. I'm just mentioning it because if there's younger advisors listening that want to get involved and do things around this, then maybe check out the CISI Financial Planning Week. Alan, you had a point on this.
Just one comment on it. To quote our learned friend, Mr. Andrew Hart, words are weapons. I've always felt that week, that phrase, that description is uninspiring. Financial Planning Week, because most of the public don't really want a financial plan. If you redesigned that, renamed it, called it something like Design Your Ideal Life Week, or some sort of future focus, something that was interesting, engaging. But no one wants the input. I don't want a financial plan.
Yeah,
I want clarity, confidence. I want to identify my future. And because as I understand it, this is something people advertise, and members of the public can walk in, can phone up, and get a financial plan. But I think they could sort of freshen up the branding around Financial Planning Week.
Financial Success Week.
The website page is not very good.
Okay.
I can't really find much on it, so it's a bit of a weak topic.
Right, next thing on the topical tidbits. Storyteller again, new HMRC app. Make this exciting and make it short.
You're really moving us along fast this week. I like it. I think it's new to me, or certainly it's been refreshed. HMRC have got an app which you can download to your phone, and it's really good, surprisingly good. You know, the stuff that you can go online and find you kind of where you are with your tax, and you can actually pay your tax. You can get your pension forecast, all available at the click of a button. It's very useful.
I've had the HMRC app on my phone for like 2-3 years. So is it?
No, they've upgraded it, refreshed it. There's a lot of information, a lot of data on it. It's worth checking out.
Good stuff. Thank you, Smithy. Wodge.
Yes. What's the next thing on the agenda there, Nick?
I'm not going to tell you because I know you haven't got a clue. Your Irish Ideas Exchange.
Oh, yeah, the Irish Ideas Exchange. Oh, my God.
He's got no notes. He's a master. He's a master.
Yeah. And they'll also see that I was deeply uncomfortable with the content of some of today's podcast, owing to the Irish versus UK cultural differences. I was still mesmerized by the guilt talk. Anyway, the Irish Ideas Exchange is finally happening on the 22nd of February. And the reason I wanted to say it is for a number of reasons. Number one, Dave Quinn has been very kind to give us up his office. But that comes with a little bit of a small problem in that there is only 12 spots available. Eamon Toomey from Step Change has agreed to come in and facilitate it. So that's brilliant, and thank you so much, Eamon, for doing that. The problem is that more than 12 people wanted to go, and there are now, when you try and do something that's supposed to be, I'm doing this for goodwill and to sort everything out, and now all I've done is piss people off. So I'm really, really, really sorry.
Classic Wodge.
For the people who didn't make it onto the first list, I'm sure a couple of people will drop out. It won't suit close to the date. And I'm also sure if there's an appetite for this to go further, of course we can find a different venue with more people. But I thought the most important thing was get it off the ground. So looking forward to the 22nd of February and see where we go with that.
Well done.
So at some point, you'll just chuck a few quid in and book somewhere, book a nice private room or a breakfast place or whatever.
True, and I think, look, we learned from the way you guys have done it, and what we've said is Eamon is going to do it, facilitate the first session, and if we go forward, it has already been flagged to everybody that Eamon's is a paid role going forward. So we flagged all that. So look, let's just see how it goes. It might be something that's absolutely brilliant, and it also might go nowhere. I have no idea which might be the case, but looking forward to it nonetheless.
Well done for putting it together, and good luck with it. Yeah, well done.
Yeah, good stuff. Okay. Moving on to the next topical tidbit, myself and Mr. Smith are down for this one, and this kind of leads in again to the lifestyling thing, and you know where there's blame, there's a claim. A story in FT Advisor, and there's a link to it in the show notes. This guy who effectively had a Hargreaves Lansdown SIP, I think, and the guy is a compulsive gambler. Diagnosed psychology-wise, psychiatrically-wise, as a compulsive gambler. And he's effectively gambled away his pension fund. He's gone into some bloody awful derivatives or something, ultra volatile, make a zillion, lose a gazillion. And now he's complaining to Hargreaves Lansdown that he shouldn't have been allowed to go into those things, that someone at Hargreaves Lansdown end should have been looking out for him. And this is a very difficult moral conundrum. As you might guess, I'm on one side. I'm very heavily about this. It's completely this guy's fault, and it's not Hargreaves Lansdown's role to police people who want to piss away their pots. It's up to them. There'll be other people who say there's a duty of statutory care to these people, but you don't. Hargreaves Lansdown is a, in quotes, light touch execution only, not quite advice thing. We certainly with our own clients, with IFA clients, with the kind of real financial advisors where we have deep relationships with clients, we would know if clients were behaving in a way that was detrimental to their long-term wealth, and if they suddenly started acting out of character. But I don't know. I don't know if you guys saw that story and have any views. I think it's this guy now complaining that he said that he wants Hargreaves to put him back where he would have been if he hadn't gambled his pension fund. I think that's a bit rich. Any thoughts?
Yeah. So he doesn't have a leg to stand on because very clearly Hargreaves Lansdown are not an advisory business. They don't give advice. I think it went to FOS. They kicked it out. They said, the onus is upon you. So first of all, big warning sign for anyone who's a DIY. Thoughtful financial planners do provide an additional role of counselling, of care, of trying to make sure that their clients protection, all those things. If people start doing those sort of things, they'll do your very level best to explain why it's not in their best interest, which of course you don't get on just going buy your own stuff and buying your own funds and trading them. I raised this exact point from the last trap because as a customer of a couple of, including HL, I'm bombarded with stuff. This is the duty of care.
That's the point, isn't it?
It's about having misaligned incentives, and as
they want action. They want action.
Charlie Munger said this. Incentives drive all human behavior. It is in the interest of Hargreaves and AJ Bell and all these other platforms to get people to actively trade. They made a lot more money off this unfortunate gentleman than they've ever made off me because I wouldn't be trading in and out. So. Yeah, I'm a good customer to that. And so are anyone else who buys and sells, which is one of the reasons that they send all this guff on a literally weekly or every few days basis, which encourages. So the guy, unfortunately, doesn't have a leg to stand on legally, but I do believe that these platforms who manage billions and billions of retail customers' assets do have, how are they signing off their kind of corporate governance and their sort of all those other things by
well, it's the conflict. As you said, they've got a duty to their shareholders. That's their primary duty, is to maximise profits.
Right. Okay. So, buyer beware. It's a really bad story.
Beware. Grow up. Stop relying on someone else. Wipe your own arse. This bloody society, Christ.
Well, disagree with that.
That was poetic, Nick. Pisses away their own pot. Pisses away their pot. I like that one.
And I've got arse in as well.
Added to list. Okay.
Now, Smithy, you are... Yeah, this has been a topical tidbit for like 7 months. You're recruiting, apparently.
It hasn't. I don't think I've ever mentioned it. That you've forgotten. I just wanted to put it out briefly. We are coming into the new year. We're recruiting financial planners. I think we've probably got enough. We're recruiting for one planner. We'll probably recruit again later this year. What's quite interesting is there's a huge demand. We literally, sorry to any recruitment consultants listening to this. We don't need recruitment consultants paying them 20% plus VAT of salaries. We haven't even. This, I suppose, is the impact of social media, frankly, and having a trap helps. I posted 2 posts on LinkedIn a week apart. I've had about 35 really good quality applicants, which is pretty good, to say the least. The hardest thing is identifying, because I only need 1 right now.
Cool.
Thank you, but we'll need more.
Media balls awake.
We remain, as a business, we remain very ambitious. I can see that this the whole world is kind of beginning to wake up to the kind of the philosophy that the 4 of us have embraced for many, many years, which is creating more opportunity, which means we'll embrace technology as much as we can, but we do need more high quality, humans in the business. And the summary position is there's a lot of really, really good financial planners out there looking for a home that just sort of embraces all the stuff that we espouse.
What's the best way for people to make contact with you?
Alan@capital.co.uk.
Okay, lovely. Carl, your finger was raised.
Yeah, can I just say, myself and Alan have had a number of discussions, kind of 1 or 2 longer discussions about this, and he's some great ideas that were kind of aligned to the way I was thinking, and we've teased them out, and about how to structure it going forward, and especially as the business matures a little bit and that kind of stuff. So look, my overall point is, number 1, if you're a financial planner in the UK, go join Alan and his team. They're absolutely phenomenal. But secondly, it's so important to have people to bounce ideas off. So people who you deem have the same mission, values in business, perhaps life, but definitely in business, that you can actually pick up the phone, because I was kicking things around in my head, and I've teased these things out with Alan. We'd had 1 Zoom call, a couple of texts and 1 call, and it does really, really help. So having your kind of tribe around you that you can bounce ideas off, really so important. And just wanted to make that point now.
Very good. Well said. Okay, Smithy again, quickly, Finimize app.
Yep, just come across this. Finimize have been around for a while. They are effectively content creators that create a lot of content. Some of it is a bit busy about what the China
owned
market.
by Aberdeen now, Alan, or Standard Life, just FYI, yeah.
They are, which I see as that's one of the smarter moves I think Aberdeen have made in recent times, is recognise the importance of high quality content, because people consume it. You create it. You're a content creator, Andrew. And this is done at scale. They have got an advisors section as well, where you can sort of tap into it, pay them a subscription. You can share some of their, it's pretty good quality actually, but there's now an app. It's had a website for a while. It's quite a useful, interesting app. That's all worth checking out. Finimize.
But they do
Great
fall into, again,
stuff.
the bracket of they just want noise and action. So they were big promoters of crypto, big promoters of NFTs, anything that's flavour of the month, that their millennial readers want to know about. So yeah, I'm not too.
But they've got everything that included in that, because there's a market for that.
Yeah,
They've also got
more
much more
to people, more distraction. But yeah, they're doing some good news.
Fine. Okay. Sort of the Ultra. You have your you have a conference, right? Did you ever talk about it?
So very briefly on this. So Humans Under Management London is on the 7th of November. I've decided to keep it the same venue, because switching venues is just too high risk, too much hassle, too much effort. So we're back at the Royal College of Physicians, a limited number of spaces. I'm looking for speakers. So if you know any world-class speakers that you think will fit well with Humans Under Management London, please do email me, Andy@humansundermanagement.com. Please don't CC a speaker in, just email me with the speaker idea and maybe obviously a link to their website, and then I'll take it from there. That's it. Back to you, boss.
Is Nick still cancelled? Yeah.
We're both cancelled, mate.
No more Nick Lincoln. Yeah, thank God.
We're both. Well, yeah, that's done. That's in the part. Okay, we're talking of superb live events. The live event that everyone's talking about in the world of financial services is Trap Live, happening on May the 9th. I think that's a Thursday, but it's May the 9th. From about 4-ish, it's going to be around 3 hours. I'm talking a bit about conjecture here, because after we've recorded this, dear Trappists, the 4 knuckleheads here, the Trap Pack, are going to have a discussion about it in more detail. But some stuff I can confirm to you. It's May the 9th. It's going to be at a place called Lola's, which is at the Hippodrome, London. Basically, you come out of Leicester Square, one of the exits, and it's there. The entrance is there. It's so easy to get to. Lola's is a fantastic place. I've seen a podcast there that was recorded. The sound is brilliant. The lighting is brilliant. There's a bar there, actually within the auditorium, and we'll include a couple of free drinks in your ticket price. And there will be a ticket price, because this is not inexpensive to hire this hall with the AV and everything else that goes with it. So details will start coming out, but May the 9th, that is definitely happening. We've got the venue, Lola's at the Hippodrome. I don't think we need to add anything to that, guys. Are we okay?
We'll be launching tickets on the next Trap episode, so listen out for it. Yeah.
Okay, that's great. And thank you very much, Andy, for that. Okay, so we are at 35 minutes in. I'm going to see if my potato peeler is working. Oh, the joy of hearing the potato peeler. I've never been so happy. We can move on to the meat and potatoes of episode 38. And Trappists, this is a bit of a back to basics. Let's just remember the important stuff that we kind of build things from, the fundamentals, because sometimes we can get lost on esoteric things. And this is about the fundamentals of investing. And I think certainly for our younger Trappist members, you'll get some value for this, because I can only imagine that your heads are spinning at the moment. There's always something shiny and new on the block. And we know that crypto, for whatever reason, seems to be, it comes in waves, doesn't it, crypto? And crypto seems to be the sort of the current hot thing du jour. And we want to push back against it. And I'm going to start off on this, I think that's what we agreed at the start of the show. It's not an asset class if it doesn't produce an income. That's the end of. If it doesn't produce an income, it is not an asset class. In my opinion, there are 3 asset classes: equities, property, and bonds/cash. They all produce income. Okay, when you buy a share in a company, you're buying a future income stream. That's what you're paying for. When you buy a commercial premises or a buy-to-let, you're buying it really for the rent. And if you get property appreciation on top, that's a bonus. And if you buy a fixed income asset, you're going to get a fixed income. You may get some gain on the price of it, depending on what cycle in the interest rate cycle you bought the fixed income. If it doesn't produce an income, it's not an asset class. Gold is not an asset class. Crypto is if it's anything, it's a currency, but it doesn't produce an income. I can imagine that the pressure on advisors, certainly advisors coming into this thing of ours, is immense to show clients the new shiny thing on the block, or they're getting badgered by clients to say, why aren't you putting us into this new shiny thing on the block? We talked in the last episode about how crypto is now available in the US through an ETF. And, sure as sunshine follows showers, that's going to come over here in some form or the other. And we are going to get clients saying, we want some of this. And I think we just have to remember, we stick with what's always worked, not what's just working now. And by the way, if you think crypto is working, I've got Alan's Bulletproof Entrepreneur, an episode or so back with Ray Trapani. Just that lifted just a little bit of the sewer lid came up, and you saw a little peek into the sewer, a little peek where that sewer is gushing all the time and there are rats in that sewer. And we don't want to be involved in it. And I'm just putting a clarion call out to our Trappists, to the advisor community. You know what's right. You know what's worked. Have faith in yourselves. Just take the vitamin C yourself and stick with what's always worked, and do not be distracted by this tosh, because it's disastrous. And I haven't really got much else to say apart from that. I can see Andy's going to come in next, I think. I do have an investment philosophy, and I share it with my clients. I put a link to it in the so-called show notes, and it is exactly what you'd expect me to be telling my clients, that we think it's very hard to outguess the market. We don't want to buy the needle. We want to buy the haystack. And we don't time the market, and we invest in asset classes that produce income, because they're the only asset classes that are genuine asset classes. Right, that's my soapbox. Mr. Hart.
That was great, Nick. Thank you very much, mate. If you don't believe in something, you fall for anything. So you clearly do believe in that. I've got 3 points. I'm going to briefly sort of go through them. The first one, I'm sort of taking this from the advisor's point of view, so hopefully someone else will maybe look at it from the sort of client's point of view. The first one is peer pressure. This is mainly through older advisors who work within your businesses. A brief story for me. When I first came to this business, my first role within 3-6 months as a financial advisor, one client came along with a few quid, and I thought, brilliant, this is my first client to get my teeth into. I spoke to an older advisor who at the time must have been about 55. I said, what do I do with this? Like, what are the options? And he grabbed this brochure on his desk and he said, well, this is doing really well. If you have a look at the monthly performance here, all it's done is just go up and up and up and up. And I looked at it and I read it was Arch Crew. And thankfully, I didn't pull the trigger on it, and I was a little bit more...
Yeah, Arch Exactly. John Maguire, who then went to work in a fish and chip shop somewhere outside Bath. Anyway, sorry, Andy.
Luckily, in my naivete, I decided to not pursue that, and I went with actually a fund that was set up by 7IM. They were the first to sort of do multi-asset funds. Anyway, so I sort of dodged a bullet there. But why would me, as being in the business 3 months, ended up putting this client in a better fund than this advisor that's been in the business 30 years? It's insane. So there will be peer pressure from older advisors who say, you know, who the hell are you, being in the business 2 years, listening to this crap called trap? No, we do things differently here, and these are the shiny things that we want you to invest our clients, you know, your clients' golden coins into. So peer pressure is a huge one. Next up is I'm going to call media pressure. This comes from 2 angles. The first angle from an advisor is trade press. So this is, you know, magazines written by, you know, non-practicing financial advisors for financial advisors to consume. They obviously cover adverts of everything, and usually the worst investment is the loudest when it comes to marketing. So you'll be bombarded by this financial trash. Again, be very aware of it, and you're there to protect your clients from all that guff. Finally, it's mainstream media, money sections, you know, the ones that report the weekends mainly. Again, these articles are generally written by young, broke, investing illiterate journalists. And they frequently show their cards on social media when they ask ridiculous questions about money and investing. And then the next weekend, they put an article out about something that they claim to have authority on. Yeah. And the other thing as well, trade press and the mainstream allow all this financial trash that's being created to advertise on their platforms. Everything that's blown up, in hindsight, I'm almost certain they've had exposure on these mainstream platforms, but there's no recourse. At the moment, these mainstream platforms are advertising or allowing to be advertised on their platforms whiskey cask investing. Sounds great. Everyone wants to get involved in it. All of this stuff,
Christ.
Excuse the pun, is the flavour of the month at the moment, and all of it will blow up in the future. Again, there'll be no recourse. Here's the crazy thing about it. They'll report about whiskey cask investing blowing up after allowing all the companies that are selling this crap to promote on their platforms. It's a little bit like Channel 4 exposing Russell Brand for being a monster when he was a monster, if he was, inside their towers. You know, so they allow it to happen for 15 years, and then on the 18th year, they do an expose about it. It's insane. So that's what's going on. And the third thing I'm going to mention is new ideas pressure. So there's constantly new ideas being thrown at you as a young advisor. It's always what's working now. And you might feel a little bit silly. Why do I not understand about whiskey cask investing? It seems like a good thing, and FOMO kicks in. People want faster returns. The longer you're in this business, you should just shrink your circle of competence. You need to unlearn a load of crap. And you just get to the point where you realize that the returns all come from global equities. So the best portfolio is the one that clients are going to stick to at the highest allocation to equities. Don't ever call them high risk. They're higher returning portfolios. Asset misallocation is, you know, pervasive in this business. So that's my third point. So just to recap, it's peer pressure, usually older advisors in your firm. Media pressure is dangerous for advisors and clients. And then the third thing is new ideas, and they're always going to be coming along. So that's my points. I think it's Carl next.
Lovely. Yeah, Della Voce.
Great stuff, Andy. I had some kind of similar points. I love the peer pressure one. It reminded me of when I set up on my own back in 2010, and, you know, the broker consultant stroke fund managers being sent down. And one of them was Standard Life coming in and telling me that GARS was where it was at. And I was like, I don't understand it, so I'm not going to put any money, or recommend any clients go into it. And they were like, we've put our whole pension fund into this, but you rock on, dude, and you decide you know better, you know. And so sometimes it's harder to resist that peer pressure because you might feel a little bit silly. So just that's kind of a point worth noting. I shared with you guys the first line of from some crowd called Bitpanda Partnership, who wanted me to unlock new revenue streams. They also opened the email with wishing that the email found me well.
It makes my skin crawl just outlining it without having to read it.
Yeah, but it's like we want you to sell Bitcoin and NFTs and all this kind of, it's just madness, right? But if you're starting out and you need to get a few quid into your firm, I could see how it might be attractive, especially when, if you're a younger advisor, a lot of your clients might be your mates and they're all down the pub and they're all talking about Bitcoin and blah, blah, blah. So, look, forego the instant rewards that may or may not come from that. And as Nick says, there are 3 asset classes. Make sure that your clients, you are doing them the best favor ever by making sure that they invest in those kind of asset classes. What's driving me mad, and I put it into our own group during the week, and Andy said, Carl, it's not going away because it's marketing departments justifying their existence, but also fund managers justifying their existence. These weekly and monthly newsletters. Now, it seems to be, if we're a big firm, we absolutely have to do it, right? Now, so I've gone in and I've looked at a couple of them, and they're largely history lessons. So they tell you what happened in the last, but it's very recent history lessons. Here's what happened in the last week to try and find a reason the market went up or down in the last week, and then some fudge as to what may or may not happen going forward. They are absolutely and utterly pointless. But it seems, you see, this is the point. This is why things are not black and white. It seems the clients want it. It seems the clients like it.
Yeah.
And this is why you gotta, so we never, I've said this before, we never used to do an investment update, but our clients started saying, I'd really like to hear what you think, even if it's only a couple of times a year. So what we try and do is give some figures on as to, the types of funds that we're recommending to our clients, how are they doing, and then give kind of an overview as to what our investment philosophy is. And it might just be saying the same thing, but in different language. So I can go and get up on my hobby horse and be talking about how pissed off I am that these people, how dare they, and they're adding no value and they're making it up and blah, blah, blah. But if the clients want it, I can understand why these firms are doing it. So look, it's just one of those things. Nearly done. But one other point that we need to be aware of as more mature advisors is, because I've had this, where we just seem like dinosaurs by saying Bitcoin is a load of BS, right? So you need to have a little bit more in your armory around why. And what I've been using is the volatility. So I've spoken about the volatile price over the last while, and that my story is being suited nicely at the moment because everything is kind of slipping. Yes, Nick.
Just quickly on that, just to clarify, I mean, I am aggressively against Bitcoin as an investment. I do think there's a case maybe because as the fiat currency system in the West kind of gets devalued by the printing of money, and one day, these bills will have to be paid, that maybe there is a call for something that's decentralized and a way of exchanging value and paying for things. But that doesn't mean it's an investment. Just want to get that out there. I'm not, the concept is interesting to me, but it doesn't mean somehow
look,
invested.
I hear you. I can't see.
You heard it here first, listeners.
Yeah, I can't see it happening anytime soon. And until I can see that this thing is mainstream and I just can't. I can't get this thing that someone decided we're going to issue a number of things and that's it. And Ray Trapani on Alan's Bulletproof Entrepreneur podcast mentioned that they felt that although there was a load of, I'll choose my words carefully, allegedly fraudulent activity going on, he was fairly sure they were actually coming good and that they were going to have a real coin available. Like, so why don't the four of us just decide to have the trap coin?
Let's do it. Let's launch it. Beer tokens.
This is what the thing is. This is.
Oh, hang on. Right. Okay. We've talked a lot about Bitcoin in the past.
Over to you, Alan.
Can I just clear? Yeah, I'll just do a couple of quick points. Big difference between Bitcoin and shitcoins. And my close personal friend Ray Trapani created just a coin out of nothing. And as you say, Andy, you heard it here first. Nick Lincoln gets behind Bitcoin. That's what you said.
As a concept, I'm open-minded to it.
Just to clear that way in terms of my thinking on Bitcoin. You're right. One of the reasons that people support Bitcoin is a hedge against inflation. That's what they're saying. When you've got a limited supply of something, the hedge against inflation. My answer to that is my hedge against inflation is the great companies of the world. That has got a 200-year track record of being a solid, reliable hedge against inflation with real organization and real companies, not a kind of newly made up currency. Undoubtedly, there is an application for it, but I'm not quite sure exactly what it is yet. And your point, Carl, we all get a lot of these emails and messages all the time, but Bitpanda, that's a new one on me. God. I can't imagine just the very name. Who the hell is going to put their money into Bitpanda? Hey ho. Can I just take this? I'm going to take this in a slightly different route in terms of what I think is really important for anyone, any listener here, any advisor, anyone at all, is to have a very clear philosophy and a documented, thoughtful, well-researched philosophy. Now, if your philosophy is Bitcoin, is crypto, is active managers, is whatever it is, then that's fine. It's a starting point. However, that philosophy needs to be built upon a lot of research, a lot of analysis, rigorous empirical data and facts, not speculation. We know that investment, I always think, is a bit like religion, politics, sport. Everyone's got an opinion. Everyone believes that their thing is better than everyone else's. So the starting point is build a philosophy, but build it on facts and data, not I think this, or this is a good fund, or what. So let me just tell you a bit of a short story about my own journey to a philosophy, a core investment philosophy.
Grab yourself a drink, a very long drink. It's story time with Alan Smith.
Keep drinking, Nicholas. My business is 20 years old this year, so clearly we've got a lot of history. And you come into this business, 2004. There's a very different environment to what it is today, obviously. So when we started, I knew no better, and of course, I came from a large institutional asset manager, and knew no better than active funds. They work, it makes sense, and we just got to choose the best ones. Over time, as we got a little bit more sophisticated, and when platforms first came along, we were able to embrace a sort of a step-by-step process that worked really well for clients. And you look back at it now, and forgive me, but the times have changed, and we do things quite differently now, to say the least. But we'd meet an initial prospective client or an existing client, and we do a risk profile questionnaire, and they would come out at whatever, 6 out of 10 or 8 out of 10 or whatever. And then through the platform that we use, we were able to populate the risk profiler with particular funds. So let's say it came out as 50% equities, 80% equities, and then it was divided out amongst geographies, UK, global, etc. And then the platform facilitated the fund choice. So it would be, whatever, the Old Mutual blah blah fund, the M&G XYZ fund. And it looked pretty good. It looked quite sophisticated. The underlying fund research was, and I don't think they're even around anymore, but the fund research was an organization called OBSR, Old Broad Street Research.
Yeah, I remember that.
So they're a third party. So that's a good story. And I honestly believed in it because I thought there's no financial advisor firm. We're a micro business. I think there only was a couple of us. There's no one has got the resources, the budget to do deep fund research to the level that you'd expect to do it. So having a third party, full-time analysts, professionals, etc., who are meeting with the fund managers, engaging with them, asking them questions, drilling them down in terms of their fund performance. And, it seemed a very compelling proposition. And we sold it and it went fine until it didn't. And when it didn't was 2008. That Andy was still wearing a polyester suit and smelling of desperation. But those of us who were sort of advising in those days, and certainly were.
Did you have hair back then, Alan?
I'm just going to let that go. And we were recommending these various funds on the back of Old Broad Street Research and their analysis. And every quarter they would do an update. So they email us and say, right, these funds, we've been reviewing this fund. And because we don't have the discretionary permissions, we have to seek clients' permission every time we make a fund switch. We would always dread when they came in. It was a great report when they said, we've been reviewing the market, no fund switches this quarter. Hallelujah. But every now and again they'd say, oh no, this fund, we've done some further research.
We got 9 this quarter. And
no, so they used to have to, they say this fund is going to change. And we had to email out all the clients. And then by the time you've got your last client approval back,
email, and you were sending stuff in the post, getting wet signatures, and it must have been a bloody nightmare.
Pigeon. No, we did have emails in those days. Anyway, so markets absolutely cratered, as we know, 2007, 2008, markets collapsed. And we were getting these emails saying, right, we think this particular one, and I just remember it so well. There was, I don't know if even, again, the fund is around anymore, but there was a pretty focused, aggressive UK equity fund. It was called Scottish Value Trust. And it collapsed, right? It'd fallen about 60% or something in that period of time. Old Broad Street Research mail us and say, right, we've been analysing this fund. We feel that the manager was taking more risk than he should have done. So our recommendation is to sell and replace it with the M&G UK, which is a much more sort of mainstream UK equity fund. This is the right place to be. Even then, I knew that is just intuitively wrong, because why would you sell a kind of punchy, aggressive fund after the market has bloody collapsed and move it into a sort of a mainstream pedestrian type of fund at that time?
Scandalous,
but we've signed up for this, so we can't override it. We've told all our clients this is what we do. We've got these experts, so we thought, through gritted teeth at the time, I thought, well, we're going to have to do it. But I made sure that I tracked. So we wrote out to the clients. We moved it from this aggressive fund into the pedestrian fund. But I thought, I'm going to track what happens to these funds after we've moved out. Well, you can only imagine what happened. Scottish Value Trust bounces right back. It's the highest performing, top performing UK equity fund the following year. It was up 100%, but we're not in it anymore, or our client's not in it anymore. And I just thought there and then, this is a load of bollocks, to use the polite word. It does not make sense. We didn't know quite what to do, but I knew this wasn't it. A version of this, incidentally, is still going on. All the
and you have to pay for that service,
had.
by the way, Alan. You have to pay for that service, by the way.
Yeah, you have to pay for that service. Third-party independent research. And I was just looking at this and I thought, this is nonsense. It's embarrassing. It's shameful, really. And we've done this because we've subscribed to it, because theoretically it makes sense. And there's versions of this still going on to this day with third-party discretionary managers, you name it. There's people still doing exactly this. I didn't know what the answer was, but I knew it wasn't this. So and I've talked about this in the past, I looked around the marketplace and I found an independent third-party investment consulting business called Albion Strategic Consulting. We hired them, we got them in, and from then on, we built our investment philosophy from the ground up. We literally, myself and 2 colleagues here who are still here, got round a table with Albion, and we literally started with a blank piece of paper. First question we were asked is, do you believe markets are efficient? Yes, no. The important point here was whatever we said was just an opinion. So, and you could say any answer you wanted, whatever you thought, but you had to find the empirical data that back it up. So the question, do you think markets are efficient? So the answer, the immediate answer is, well, in large developed markets like the US, Europe, UK, etc., they're probably very efficient and prices are reflected immediately. But my initial thought was, well, in certain markets, unless, smaller companies, emerging markets, there probably is inefficiencies that active managers can exploit. So the answer is fine. That's fair. That's reasonable. Let's check the data. Let's see if this actually happens. And bit by bit, now this process, it took us a year actually to build it from the ground up. You can do it much faster now. And we went through everything. Like your point earlier on, Nick, do you think gold is a useful place to hold assets? And again, intuitively, there's data to say, well, at certain times, gold can be a protection against inflation. It can protect the downside when markets collapse. Gold, okay, let's check the data. Again, let's check the facts. And bit by bit, you arrive at an investment philosophy. And the important point of doing this, and not just buying it off the peg, just say, I'm just going to go buy this fund because the track pack say index funds or factor tilt funds are the place to go. You need to do your work. You need to learn this stuff, because we're not going to be there when an advisor or a listener to this is sitting in a room with a client or a prospective client, and the client says to him, yes, but I think I should have some gold, or I think commodities is a good place, or I read an article in the paper saying that Terry Smith at Fundsmith is an outstanding investment manager. By the way, he's completely underperformed the market for the last 3 years, and his close personal friend. So in other words, you've got to own your philosophy. You've got to do your homework. You've got to do your research, because you will be challenged by it continually by all the people that Andy pointed out, by your peers, by your bosses, by the media, by clients and prospective clients. Do your homework, do your research, and build your philosophy from the ground up. I rest my case, Your Honor.
But it is also about confidence and also experience, Alan. So yeah, some really good points there. So yeah, confidence and experience, and the more, as the years roll on, you just become, as I say, you just shrink your circle of confidence, and you're more confident and competent what you're telling your client families to do. Nick Lincoln is the extreme example of it.
Confidence comes with knowledge. You need to.
Yeah, sure.
In other words, what I'm saying is you need to internalize this. There's no point in just saying, I'm going to buy some Vanguard funds or something like that because they're cheap. Why are you going to do it? And more importantly, why are you not going to recommend, whether it's Bitcoin, whether it's whatever it is, doesn't matter. There needs to be a very clearly articulated philosophy, and you have to bloody believe it yourself. When you come across convincing to a client, say, this is where my own family's money is invested, 100%. I've spent hours, years, months, whatever, researching this. This is what I fundamentally believe. And if you, Mr. Client, want to do something else, then I wish you all the best luck. But I can't say that.
Isn't that the key? Exactly what you just said there, Alan. That through the research, through doing the groundwork, that you believe in it.
Yep.
Right. And that's why, if you go all the way back to, and sorry about this Bitcoin thing, but I'm just being bombarded with it, right? But if your investment philosophy is, it's Bitcoin, right? You have to have something that you can believe in and that will endure, right? So that oh shit, that's way too volatile or whatever, right? And I'll give you a perfect example, right? I still believe that bonds should be part of investment portfolios. I know that probably all of you guys firmly disagree with me. And I've listened to all those arguments over the last couple of years, or probably more, but especially last year when it was not going great. I still believe in it. I have not changed any views on that. And for me, what has always worked is what will work into the future. And looking at 1 year performance or 2 year performance is not what would serve our clients the best. So I have built, is exactly what Alan said. I've built it, I believe in it, and I'm going to stick with the plan.
Just to clarity on this from my point of view. My antipathy to bonds existed before the meltdown in the bond market last year. It just happened to coincide nicely with it that my message was more resonant. But I just think you want to be an owner of the companies. You don't want to be a lender. You want to own a future income stream. You don't want to lend.
Rising income.
I would also, and in case we come across as holier than thou, and perhaps I do sometimes, I have made every investment mistake under the sun to get where I am today. So when people sit down with me with their little pots of money and they're figuratively holding me by the hand and saying, Nick, don't screw this up because this is all we've got. What I bring to the table is over 20 years of knowledge of knowing how not to do things. It's the stuff you don't do with your money that will determine successful outcomes more than what you will do with it. So it's avoiding all the crud. And having learned all these and having sort of got this thick skin from the mistakes, having got the calluses on my hand from all the mistakes I made at the coalface, that's given me this anchor that I can drop into the ocean. So when the waves come, I'm not buffeted from this way to that way. And this is, we all believe in the great companies of the world. There'll be times when the great companies of the world are just absolutely temporarily going through the floor. And these waves will be coming over you, the pressure from clients, the media, and we just have this anchor that's in the sea, just keeping us there because we have a belief system and we don't let it get rocked by our peers or whatever the new shiny object is on the street. I think, Andy, do you want to say something?
I think Anna was next.
Okay, thanks.
I was again just making the point that a huge part of an advisor's role is protecting clients from all these other things. I'm always reminded, far too young to remember. Remember that advert, John West fish. It's the fish that John West rejects that makes John West salmon the best, or something like that. In other words, they're rejecting things. Andy, when you mentioned the fund that your senior advisor was recommending Arch Crew. Oh my God, the amount of junk that I've seen. We had an episode, in fact, that was one of our better episodes when we had all the most obscure funds. We had the shipwreck fund. But the one that I remember a lot was a one called, it was a life settlements fund. They just, unsolicited mail in the post every month. We'd received this thing. And again, this is going through 2007, 8, 9. This chart, all it did was go up every single month. Everything else was crashing around us and it went up. Inevitably, you get people, you get peers. People that I knew said, this fund, look, keeps going up every month. Again, because we had a philosophy, you just can't embrace it. And I think this is the key thing. It's like one decision removes 1,000. Instead of having all these, everything is attractive, everything sounds good. We've talked about it before. Even if you're an advisor, you see something, you think, do you know what? That is, whatever. There's always a story. Remember the water funds. There's going to be a global shortage of water. So invest in companies that create, desalinated, blah, 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 blah.
Whiskey.
They all sound good. So if you are able to create this core philosophy, it also then leads to healthy conversations with clients. Back to the framing. Words are weapons. Frame things correctly. This, my friend, my client, my prospective client, this is your family fortress. We will protect this and look after it. It makes sense. It's worked for hundreds of years. If you really want to go and have some fun and gambling money, that's your sort of speculation fund. That should go and have fun for. That's your casino money. Do what you want with, but it's not going to impact your family's financial security. And I think once you've got that framing and you stick to it and your client says, no, but I want to put 30% into it, you don't do it. You ignore that and you can't engage.
My final point on this, we're talking about investing, and I believe we are behavioural investment advisors. We need to be careful that our guns are not facing in the wrong direction too much here. Getting investment returns is important in the funds, but the crucial factor, certainly in the early stages, is your contributions need to be doing the heavy lifting. So you need to get really good at getting clients to invest. Their current self is constantly trying to wriggle out of doing anything good for their future self until you come into their lives. So you've got to try and get your clients to invest and contribute a just about uncomfortable amount every single month to build this wealth in the first place. If you've got someone who's aggressively contributing and they're in a crap fund versus someone who's in the best fund and is not contributing hardly anything, their returns are going to be night and day. The person that's heavily contributing will end up having a rock star retirement. The person that's contributing nothing but in a great fund will end up with nothing. So the contributions are important. That's my final point.
Okay, great. That was a really good meat and potatoes, I think. We're at 67 minutes here. Maybe just to tie a bow on this. Younger Trappists, if you subscribe to the physical version of New Model Advisor, if it still exists, if there's ever a fund manager wraparound that particular edition, that is the thing to avoid. Now, without any further ado, I can see at our front door. Please, can I see at the front door? Can I see at the front door? Here we go. Okay. It'll probably start halfway through my blurb now. It's time for the Trappist questions. Thank you. The letter opening might work, actually.
Oh, sorry if I've done the wrong thing.
Yeah, that worked. Yeah, Trappist questions as well. That way. So it's time to open up some of these envelopes we get from our beloved Trappists. If you want to pose the Trap Pack a question, there's a linked pin on X or Twitter, whatever it's called, at the top of our timeline. Submit your question there. We will get round to it. We've got a hopper full of questions. We're still going through from late last year. We will come to you. We're doing it sequentially. Just bear with us. And this first one, I've just opened it up, as you heard. Is from Chris Bowers, and Chris has given us a LinkedIn address, so I will put that in the show notes. Chris Bowers asks, thanks for the great insights into the industry from you all and for the ongoing commitment to the podcast. Do you think financial firms would benefit from working together with other lifestyle services, psychologists, health practitioners, etc., to help create a one-stop shop for people to live their best lives financially, mentally, and physically? Della Voce, lead off.
Yeah, I loved the question because I firmly believe that yes is the answer. That's what Future You, which I've spoken about before, is all about and will be all about. Now we're trying to, so basically Future You, just a quick reminder, 2-day event, and we brought in not only financial planning people, we brought in, say, estate planning people, but then we also had psychologists, we had nutritionists, we had fitness coaches, that kind of stuff. Went down a bomb year 1. Did we make any money out of it? Not at all. Year 2, absolutely packed, sold it out. Couldn't believe it ourselves, and did have at least half of the people there were not clients of ours or knew us. So people So all I can say is people want this. The tricky part is not everybody will want it. And do remember, when everybody comes to see us first, as who said it earlier on, nobody comes in to for financial planning. So that you got to be careful if you go down we're going to have a psychologist and a fitness coach and a nutritionist talking to you because you come in to talk about your pension. I don't think you're going to do the business. So it's a little bit tricky how to introduce it. I do have an idea as to how we might elaborate on this discussion, how these things might work. But I would start, as opposed to hiring these people into your business, I'd do you could do a dinner and have a guest speaker talking about this, which has nothing to do with funds or financial planning. So great question. Go for it, is what I would say.
Smithy.
I think I've talked on this podcast in the past about the idea of having your advisor's black book. It's your black book. It's a range of third-party professionals that you just know, you've vetted, you've spoken to, etc. This is where this comes in. I'm not a fan of having psychologists on the payroll or in part of our team or referring them to clients, but you will know, because we work closely with our clients, when there are situations that they could probably benefit from spending some time with somebody else, be that an executive coach, a personal coach, I don't know about nutritionists, but generally speaking. And there have been times in the past where I've just had a conversation with somebody. I said, you might benefit. Just have a call with this guy that I know. He's been really good. I've done, so I've had plenty of coaching myself over the years. So I've got in my sort of, business black book, a range of people that can really add value. So I would be doing it more on a reactive basis, based upon the relationship we've got with the clients, some of the things they raise, some of the challenges they may be going through. And I think it's an important thing for advisor firms to build up a good network of not just accountants or lawyers, but others that could be beneficial to support the client relationship.
Okay, I don't really have anything to add to that. Mr. Hart, you're looking as if you're comfortable to move on to the next section.
We can move on, mate.
Okay, let's do it. Okay, let's go on to Culture Corner and let's see if this drop works. Wow. I tell you what, this is a temperamental piece of software. Okay, Culture Corner. We've all got contributions this week, and I'm not going to tell you what they are or who's going first.
Over to me. I don't know how we missed it. We quite like. I think they've been raised many times in the past. These kind of Netflix shows or Amazon shows where there's been this large scale frauds and all sorts of crazy stuff. I don't know how we missed this one. There's one called Man on the Run, which is on Netflix. Came out last year, and I just watched it recently. Oh my God. It is just an incredible real life story. It starts in Malaysia, and Malaysia decided to raise a sovereign wealth fund because everyone else has got one. We thought we'll have a bit of this. Mm-hmm. They raise this fund. They raise money by issuing a bond. And that's, Malaysia are a sovereign country, obviously. They're not investment grade, so they have to pay more interest than others on this bond. But it was just a complete and utter fraud. There's a guy called Joe Low. He's a Chinese dude who's never been caught, incidentally. But the Malaysian Prime Minister is up to his neck in this. He's banked hundreds of millions of pounds. It's just a mess. But the interesting thing is, London, the UK is involved with this, of course. Coutts Bank are firmly involved. The Royal Bank of Scotland, and of course, who else?
B Corp.
Goldman Sachs. Goldman Sachs. They've facilitated. I mean, that's just another thing as well. How are they completely guilty, and they just paid, I can't remember, $10 billion fine or something, and crack on and made about $50 billion from it. It's well worth watching. You're just shaking your head and sort of wondering how the hell these things can happen. But it did, and it's entertaining, and it's a true story. Man on the Run.
Great stuff. Next person, go.
Over to me. This is, I suppose, a bit in the weeds tech sort of recommendation, but it's a great company, so I'm going to mention them. I've been using a company called ConvertKit to sort of build my email list for the last 6 or 7 years. I think I switched from MailChimp. It's an awesome bit of kit. If you don't have an email sort of newsletter service at the moment added to your website, then I recommend checking it out. I think they've even got a service or an offering, a freemium offering, where if you've got less than 1,000 email subscribers, you don't pay for the product. So they're really, really keen to build it out. So do check it out. It's called convertkit.com. That's it. Over to you, Carl. Book recommendation, mate.
Nice. Just before Carl comes in on his, Andy, you've got numerous brands. I mean, your GDP is about the equivalent of Malaysia, which I understand you're funneling into some sort of sovereign wealth fund. Which of your brands do you use that piece of software with? Do you use
that's the good
ConvertKit
thing.
with?
You sign up one account with ConvertKit, and then you can send emails from different brands and use different reply alls. The only other email newsletter service I use is the built-in one to Squarespace. So yeah, ConvertKit allows you to sort of operate via multiple brands, which most companies don't. So yeah, does that answer your question, Nick?
Yep, thank you for that. Okay, now Carl, do you want me to lead you in on yours, or are you on top of it?
I put it beside me so I wouldn't forget.
Brilliant.
Good lad.
Stephen Bartlett, The Diary of a CEO. It is bloody brilliant. Loads of people have actually recommended it to me, so I think loads of people got it for Christmas. It is an outstanding book. I can't recommend this more highly. It really is good. And Ronan Quealy, who works at Metis, told me to follow Stephen Bartlett about 2 years ago, and I was like, nah, yeah, okay. I've started, Ronan, my apologies. The content is fantastic.
What's
really
the book
is.
mainly about, Carl? I've got it on Audible. What's it mainly about?
So it's the 33 laws of business and life. So he goes through but the chapters are really short and sweet. So and it kind of goes through segments of kind of 4 main areas. So
brilliant.
It's really, really good. But I've seen loads of people promoting it on LinkedIn, saying everyone should look at this. For me, like for the team in Metis, it's like guys, everyone has to read this. It's really, really good. So yeah, a very strong recommendation from me to everyone: get that book and get it read.
Okay,
Nicholas.
Interesting. I will do that. Thank you, Carl, for that. Okay, I'll close off the Culture Corner, and this is just a coincidence, but my thing is not dissimilar to Andy's. So I do this quarterly newsletter, don't I? And I'm not sure how many people actually read it because it goes on and on and on, and you have to scroll down and down. So I'm going to change it to a monthly essay, which I'll send out to my clients. But I'm not going to do it from within my company website. I'm going to use Substack. I'm not sure if you've heard of Substack. It's making massive waves in the online publishing world as a way of easily just producing very nice looking emails and getting subscribers and so forth. And if you want to, you can add paid content on there relatively easy. So it sounds very similar to ConvertKit. And I'm going to start using that to communicate with my clients, anyone who subscribes to my what formerly quarterly newsletter, and everything will be in the inbox. There's no clicking through because you want to minimize the friction. And Substack is just a really nice thing. So if you're thinking about that, I've got to get over this mental thing that clients are going to get emails from me that aren't from my domain name. But I think that's probably more in my head than anything else. And I'm going to send out my first one today, just telling everybody that the quarterly newsletter is no more. So both readers will be apoplectic about that. But I'll be doing a monthly, shorter, 5-minute punchy read around personal finance and so forth using Substack. So do look at Substack. Some really good. I mean, it's so our friend Rory Sutherland has a Substack. Everybody's got a Substack now. I think it's kind of taken over from maybe WordPress and Google had their own blogging platform, which they never, being typical Google, they kind of set up and then just never did anything with. Substack is a really, really nice free bit of kit.
Smithy's definitely going to have one by the end of next week. So
yeah, I've
already got one. I've also got ConvertKit. Just to be clear,
he switched to ConvertKit 2 months ago. Thinks it's the greatest.
ConvertKit we've been using for a long time, but that's more designed for marketing email sequences and trying to sort of sell stuff.
It's really, really awesome.
Whereas Substack is exactly that. It's designed just for newsletters. Just
the
for
design is beautiful.
Yeah, it's really nice. It's elegant.
Simple,
yeah. Whereas creating a blog within Squarespace, and I'm sure with other sort of third-party web building sites, it's clunky, and you can't even drag and drop images in. You've got to save them and then upload them. It's like, oh god. Okie dokie, that's brilliant. So what are we at? I don't know because I had to refresh the browser to get the media board going, but I'm guessing we're probably about the hour 20, 25 mark. That typically seems to be where we
quite a short one today.
So I guess, dear Trappist, that will be a wrap for this episode. We've emptied our vowels.
Nick, do you mind if I just mention one thing
without an overtalk? Go on.
No, well, there's something very big coming up tomorrow because after all, this is Thursday, the 1st of February. So the Six Nations starts tomorrow, doesn't it?
Indeed, it does.
And it's always brilliant because I saw something on Twitter during the week that 3 out of 5 businesses fail in the first couple of years. And here we all are. So first of all, everyone should congratulate themselves that they got through January. And obviously February means the Six Nations. It's just such a pity that the competition decider is the first game out on Friday night. It's just a shame for the minnows involved.
Bullshit.
But we're looking forward to it. I just love it. I just love it.
Have you started watching the new Netflix
No,
series?
not yet. My young
watched
fella.
the Scotland one when the mighty Scots defeated the English. When I was there in the pub with these two jokers, it was the best day of last year for me.
I don't remember it. I don't think it happened. And
I'll probably get to that, but I'm going to watch the
first
Ireland
one.
series for the winners. Well, I'm going to jump ahead and
It's
go to
going to
the
be
Our
an
brave boys in
interesting
white
it's
are going to
boring.
beat the Scots.
championship.
Our brave boys in white are going to beat the Scots this year. I'll have it. You
Guinness
heard
are
it
the
here
new
first.
We'll see.
Well, I
It's
don't
at
know.
Murrayfield. Right.
Okay, are we done? Do you want to talk about anything else?
No.
No.
Talk
Okay.
about the rugby
That's a
more
wrap.
if you want to.
Right.
but-
No. I'm sure. Well, let's talk about it when this actually happened. Then England are the champs.
Let's wrap this up.
Okay, dear Trappers, thanks for your precious time and your input into the show. You know what to do. Like and subscribe. Check us out on YouTube. But until the next time, from the Trap Pack, it's adios and take care out there, folks. Goodbye.
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 Whoa, made it.
Oh, the
Made
media
it.
board
That was all
worked
right.
just.
That was all right. I like
Just
that one.
about squeaked through the media board.
Just about
Well done.
squeaked through the
A
media
couple
board.
of things
right.
didn't work, did it? The post lead doesn't.